Today, we're here to talk about a very specific and timely opportunity in distressed multifamily real estate, one that we've structured for a strategic equity partnership. So let's just cut right to the chase. This is the headline that defines the market right now. We are in a period of major dislocation. In fact, serious delinquency rates are actually higher now than they were during the Great Recession.
And frankly, this financial distress is exactly what creates our opportunity. It's the catalyst for our entire strategy, creating an environment where a really disciplined, targeted approach can win.
So let's break down that catalyst. We're not just talking about general market distress, we're focused on a very specific, addressable opportunity within it.
Our whole thesis is anchored by two incredibly powerful demand drivers that are not correlated with each other. First, you've got the counter-cyclical nature of college towns. When the economy slows down, enrollment actually surges. And second, there's this huge secular trend of people moving to outdoor communities driven by the health and wellness economy. These aren't just fads, they're structural shifts that give us durable, long-term demand.
And we apply this thesis to a very specific niche: small multifamily properties. We're talking about buildings with 4 to 10 units. This is the key, we think, to unlocking institutional-grade returns in a market that's way less competitive and much more fragmented. So why this niche? Well, this is the market inefficiency we're built to exploit. The big institutional guys, they're all focused on properties with 50-plus units. They completely overlook this segment. That lets us close deals incredibly fast. Think 30 to 45 days. We're often buying from local owners who just don't have the capital for improvements, and that lets us capture much better cap rates than you'd find on larger assets, even in the very same markets.
All right, so let's get into our strategy and the numbers. We have a really clear, repeatable path to creating value and generating some very attractive returns.
And here's our benchmark. Every single asset we look at has to have a clear path to hitting a minimum of a 10% cash-on-cash return once we've stabilized it. That's a line in the sand for us. It's non-negotiable.
Our process is a simple, 4-step playbook that we can run again and again. 1. We acquire these distressed assets in our target markets. 2. We bring in professional third-party management to get the operations right. 3. We do strategic renovations aimed right at students and young professionals. And 4. We optimize the rents and boost efficiency to unlock the property's full potential.
And this isn't just theory. Here's a real-world example of the financial impact. We took an 8-unit property that was yielding a 7% return, and within 3 years, turned it into a stabilized asset, generating an 11.3% cash-on-cash return. That's an NOI uplift of over 60%. It works.
Our initial goal is to deploy $5 million of capital across about 8 to 12 properties. And as you can see, we'll do that with smart geographic diversification across 6 target states, which really helps mitigate any single market risk. Okay, so that's the what and the how. The next logical question is why us? And our competitive advantage really comes down to having the exact right team for this very specific market opportunity. The leadership team is made up of 3 general partners, and we have very distinct and complementary roles. David drives asset management and tech. James leads acquisitions and capital markets. And Matt oversees all of operations and finance. There's no overlap here, just focused execution. And this unique blend of skills is really our core advantage. We've got institutional-grade financial analysis combined with disciplined CPA-led operations. We use modern tech to be more efficient, and this is crucial, we source proprietary deals through a deep, exclusive alumni network. And the whole thing is built on a long-standing partnership founded on trust.
Now, let's talk about the partnership structure itself. We've designed this for one reason and one reason only: complete and total alignment between our interests and yours.
So we're seeking a $4.75 million equity investment for a 95% ownership stake. But here's the key part. The general partners are co-investing $250,000 of our own capital. We have significant skin in the game right alongside our partner. The terms are incredibly clean and straightforward. You get a preferred return, and it's paid only on invested capital. Our compensation, it's 100% performance-based. And just look at what's not here. 0 management fees, 0 acquisition fees, and 0 asset management fees. This structure completely eliminates fee drag and makes sure every dollar is working for you. And that really gets to the fundamental principle of our partnership. By co-investing our own money and getting rid of all those typical management fees, our success is tied exclusively to the performance of the portfolio. It's the purest form of financial alignment you can have.
Our strategy also includes a very clear, defined exit for you, our equity partner. At the end of year 2, once we've stabilized the portfolio, the general partners will get commercial financing to acquire your 95% stake. This gives you a clean and timely exit, and it allows us to transition to our long-term permanent hold strategy.
So, that brings us to the path forward. What are the next steps to actually put this plan into motion?
Well, our immediate objective is to execute Phase 1. That means deploying the capital with zero fee drag to generate superior returns and prove out our thesis. Doing this will perfectly position the portfolio for that defined LP buyout at the end of year 2. We're really looking forward to discussing this opportunity further. Thank you.